This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Jim PUPLAVA joining us this morning from San Diego. Jim is founder, president, and chief investment strategist at the PFS Group, a very well-recognized host of the Financial Sense News Hour. Welcome, Jim.
Well, Gordon, it's good to be with you.
It's an honor to have you on. I need to start off right away by recognizing you for your insight in public leadership. The Financial Repression Authority has had over 35 guest interviews on this subject and is now approaching 800,000 YouTube downloads. But no one deserves more credit than you for recognizing early what was happening in this regard and going public with it. When I wrote the Financial Repression thesis paper in 2012, Jim had already been talking about it then for a number of years. So, Jim, kudos to you.
Well, thank you.
What made you, at that point, start writing about and talking about financial repression so early? What prompted it?
Well, you know, one of the things that we were looking at, and especially coming out of 2009 with the financial crisis, the beginning of quantitative easing, one of the books that came out at that time that was a must-read for all of us in the financial world was This Time It's Different by Rogoff and Reinhardt. And as I read that book and I began to think about it, and of course, then the government, we had just had the stimulus program, we had the bailout programs, the Obama stimulus program, which was close to $1 trillion. We had quantitative easing, or QE1, which was $1.2 trillion. I began to think about and do some research in terms of, we had not seen this. I mean, we had seen low interest rates in Japan for decades, but that was something we never thought would happen here. And as I began to look into it more and more, I discovered that this was a strategy that was used by government here in the U.S. deliberately, in conjunction with the Federal Reserve, back coming out of World War II, when we effectively brought our debt to GDP ratio using the same strategy until it no longer worked in the 70s. But it was looking at that, doing research on it, and I said, you know what, we're doing the same thing again, and began to talk about it. And, of course, subsequently, we've seen regulation with Dodd-Frank that circles in with regs that make it more conducive for almost requiring banks to get tied into the system of supporting government debt levels. We're seeing a number of things implemented, but the thing about it, Gordon, is we did this before. And that was the discovery that I came across in my research, that this was a very effective means of reducing what was then astronomical debt coming out of World War II.
Most people are unfamiliar with that era from about 48 through 53. That's exactly what we did. The difference was we weren't on a fiat-based currency system. We didn't have the debt to the degree that we currently have, and the amount of securitization through derivatives, the swaps market, and shadow banking system. So it worked then, but it doesn't necessarily mean it'll work again. Am I right in that, or how have you drawn any conclusion?
I think it'll work for a while. I don't think it'll work as long as, let's say, coming out of the 50s, we had more dynamic economic growth then. I think one reason that we've been able to, let's say, have it extend as long as it has is the world is in the same situation. We're seeing it in Europe today where, you know, goodness, who would ever thought that 2.2% treasury yields would look like junk bonds when you look at European sovereign debt, where a good majority of it is negative when you look at 5 years and under.
Yeah, sovereign debt in Europe to over $2 trillion is negative. So the If you're looking for any yield, they're chasing high yield, and that's considered sort of the riskless investment, which it's obviously not. The world has dramatically changed here, and I would say in the last maybe 10 months in that regard. Are negative nominal rates coming to America, and are they going to accelerate, or is this a low point? What's your view on that?
I think we've probably reached the low point in interest rates. I think the Fed, more than any other central bank, is really anxious, really, as the world's central bank, to normalize interest rates. So they were successful in bringing an end to quantitative easing, or the taper. Now, I think, is going to be where the rubber meets the road in terms of normalizing monetary policy. They would like to do it, but look where we are. We're coming out, I think when we get the final print for the first quarter, we may even get a negative print again like we did in 2014 for the first quarter. The second quarter, our LEIs right now are pointing out that it'll be better than the first quarter, but it's not going to be a barn burner. So are these guys willing to start raising interest rates? The things I'm looking at, we may not even raise until December. So I think the hard part is going to be for them to normalize interest rates, and this thing may last another 2 or 3 years. And the reason I think it can do that, Gordon, is this time we have other central banks, the ECB, the Bank of Japan, China just lowered interest rates. So the rest of the world is also pursuing the same policy. So it's not just financial repression here in the United States. It's financial repression globally.
We seem to be playing a game of pass the baton around. As one lowers the rates and then somebody else does it, we see everybody taking their turn. And I'm wondering where all this leads, Jim. Who are the winners and who are the losers in this process?
Well, there's clearly two winners here. If you are an investor, a lot of this liquidity is working its way because of poor fiscal policy into the financial market. So it's suppressing interest rates. It's driving up stock prices. So if you're an investor, with the stock market going from 666 to 2100, you've made a lot of money. If you've been invested in stocks, if you've been invested in bonds, your bonds have appreciated as interest rates have come down. And if you are a debtor, so you can go out today and get a low interest rate mortgage below 4%, you're a winner. The losers, unfortunately, in this are seniors. They are savers, because in essence, financial repression is a tax on savers. And savers are getting real negative interest rates, and that's before taxes. And they are the ones that pay the price. It was as if you read Keynes's analysis of how financial repression can work. He wasn't talking about financial repression, but he advocated basically of robbing savers to the advantage of government. And the savers are really the losers, because take a look at today. If you're in a money market fund, you get next to nothing. And Gordon, I'm just looking at my Bloomberg screen here, and on the day you and I are talking, a 1-year Treasury bill is 22 basis points. A 3-month Treasury bill is 1 basis point. And the number that I use to really illustrate the damage is, if you were, let's say, a conservative investor, you wanted to retire the year's 2000, and you were looking to get $3,000 a month off your investments. You wanted something safe. I could have put you in a 2-year Treasury note back in 2000, and it would only take $540,000 to get you that $3,000 a month. Today, Gordon, it would take over $8 million to get you that same amount of money.
Jim, I have all sorts of friends of mine who were very conservative in their retirement planning, have retired, and when they were doing their planning, they were told to conservatively plan for 6% because they were making well north of 8 and 9%. Today, a number of those people are forced to go back to work because their spending is higher than they thought and their returns are so poor. I see another group, and I don't know if you see this, is we have gutted the middle class in America, and the abilities to earn a satisfactory income against student loans, car loan, all their kinds of debt instruments that they're handling, have left them where they're not really investing in the stock market, other than maybe some minimal in 401ks or IRAs, but they're not in the market. So with the market going up, I'm not sure that the American public in general are winning. I would say maybe the top 15% are doing really well, but at some point, if America's not winning, we don't have demand in a 70% consumption economy. That's got to come home to roost. Am I being too negative in that? Are you observing the same thing?
Well, obviously, you take a look at, we monitor cash flows and where they're going, and the net, I think the figure was like a net $60 or $80 billion has gone into the stock market net since the bull market began. The vast majority of individuals have been going into bond funds, which, by the way, is part of the plan of financial suppression. So, you take a look at what has happened to most investors. They've gone through two bear markets in the last decade, one in 2000, again in 2007. So you had investors who were saying, boy, I'm closer to retirement than I used to be. I've gone through two bear markets where stocks lost 45%. I don't want to go through that again. So what they are doing is they're supporting financial repression in many ways by going into the bond market, by pouring money into bond funds. Bond fund managers have trillions of dollars to buy more bonds, driving down the price, and they've missed out on the recovery. So instead of, they might have been down 45%, but had they held the course, today they would have regained all of that, and they would have been back up again, and actually ahead. But that's not what has been done. The vast majority of people have kept their money in savings because the headlines were scary, and I think the media did an exceptionally poor job of explaining what was going on in the financial markets, instead of saying, you want to capture and take advantage of this, because when financial repression is put into place, it supports growth-type assets like stocks. Originally, it supported commodities coming out of 2009, and this is how you recapture. But that's not what happened. We had scare stories every single year. Whether you go back to 2011, it was Fukushima, it was the Arab Spring, it was the debt ceiling debate, it was the pig crisis. And when you hear all that, the public is doing exactly the opposite. They're doing exactly what the government loves them to do. They're putting their money in cash, the bond market, supporting that bond market, and really being sort of a contributor unknowingly to the policies of financial repression.
Exactly right. Because if there is a bigger bubble, in my opinion, than the stock market, if I can use that terminology, it's in fact the credit bond market. And because of that flood of money under perceived safety. Jim, what should investors be doing going forward from here? With the markets having had such spectacular rises, what do you see over the next 12 to 14 months?
I still see a rising stock market, and the amazing thing that I think has puzzled so many analysts, money managers on Wall Street is, with the absence of the public, basically on the sidelines and not really participating in this market. I'm not saying that the public isn't putting money in, because we are seeing some 401k money, but two of the biggest drivers to this stock market is stock buybacks, which this year will be close to $1 trillion. Central banks themselves are pouring hundreds of billions of dollars into the stock market, and that will be another driver. I do see, Gordon, the public eventually coming into this market, and it'll start to happen, which will give us our final wave up in this stock market, in my opinion, is the same thing when they begin to see what happened to bond investors in 2013 when we got the taper tantrum. From the summer of 2013, we saw the long bond go from 1.6% to 3%. And for the first time, the public saw their bond funds lose high single digits or double digits if you were in something like TLT. I think that period of time is coming and is before us as interest rates gradually work their way up. I'm looking at a Bloomberg screen since the beginning of the year, and all bond yields are north of where they were at the beginning of the year. So if you take a look at the German Bund, that got down to 7 basis points. The German Bund today is right back up to close to 60 basis points. Think if you had bought a German Bund 10 years at 7 basis points, and here we are 3 months later at 60 basis points, how much money you've lost.
That's dramatic, isn't it? That kind of volatility just was unheard of. You're absolutely right, Jim, in terms of where the money is coming. The buybacks of corporations have been just truly staggering, and even the planned ones are incredibly large, without getting into whether that's good investment, but they're doing it. But we have, last week the Swiss central bank saying it's got 10 to 15% of its assets in equities. We have the Norway sovereign wealth talking about buying 5% of the European stock equity market. That's their goal of an $800 billion fund. We have the largest pension plan in the world in Japan committed and driving hard and buying stocks. So I think they are just the tip of the iceberg of sovereign wealth and central banks, the kinds of buying that's going on. And if they buy equities that have dividends that are paying, they're getting better yield than they are on bonds, especially negative yielding nominal bonds.
And I think this is a strategy that you see very wealthy individuals like Warren Buffett pursue. I mean, he was interviewed recently and he said, I have 90% of my money in equities. Because he knows long-term government policy is inflationary, something that he learned from his father. And he also knows that if you got cash flow that's coming in and that cash flow is growing at 7, 8, 10%, which is something that he looks at in the companies he invests in or buys, then you are doing fine by financial repression and profiting from it, which indeed he has. He's now the second richest man in the world at close to $72 billion in net worth. And unfortunately, because the public and because the media does such a poor job of explaining this to the public, what's happening to them, they're really being overly taxed, not just at the tax rates they pay, whether it's Social Security, income tax, property tax, sales tax, and all the other taxes that government imposes on us, but also the worst tax of all, the hidden tax of inflation and financial repression that basically makes their savings worthless. And I think this is one of the dynamics that we're starting to see. The new reality of retirement is that people are going to postpone retirement. I think that they're going to jiggle those numbers again, Gordon, and I think you'll eventually see retirement age lifted to age 69. It's already been lifted to 65 to 67 for boomers. So, but it's a cruel tax because people don't realize what's happening to them. It's, what's the old analogy? You throw a frog into a pot of boiling water, he'll jump out, but put him in a pot of water and gradually turn the heat up and you'll cook him. And that's what financial repression is.
Yeah, and it's slow. It's a little bit at a time and you hardly notice it, but I agree with your observations on pensions. I believe that we're going to facing an era of pension poverty. And I believe that pensions no longer are risk-free. I think they have very high risks. And when we look at the level of underfunded pensions, public and private, it's totaling somewhere north of $8 trillion. These are staggering amounts. And why I bring that up, it says that we cannot have the asset markets fall too significantly, or it would be just devastating, absolutely devastating to the financial markets, the pension markets, who are barely getting by now, if they are, and are having to take on more risk. So the government's policy, it's like they are somewhat trapped into trying to accelerate or maintain these elevated prices, if I can call them elevated.
We see this going on for another couple of years, but eventually this is going to break because I want to come back to stock buybacks for a moment because I think they make a lot of financial sense. And the reason I say that, Gordon, is a lot of these companies have high return on equity. They're generating large amounts of cash flow. But with anemic economic growth, the last thing you would want to see a corporate CEO do is go out and build a new factory on the idea, build it and they will come, because they don't have the buyers. The growth in economics or economic growth globally isn't there. So they're doing what I call rational allocation of capital. If I have all this money, you don't want to keep it on a balance sheet because you could end up getting taken over with your own cash used to buy you. So they don't want to build a new plant because they don't have the sales numbers or the unit volume to justify it. So they're buying back their stock because there's a lack of growth globally, which is another characteristic of financial repression.
They're incented to do it because the debt that they take out to buy back the shares is tax deductible. And I agree fully in that what financial repression effectively has done is bring demand forward. When demand is brought forward, supply will go up to match it. And we've had tremendous global supply build out in the emerging markets. But it's very difficult to sustain that demand and bring more and more forward. And as soon as it starts to slow a little bit, or there's a sense, the suppliers cut dramatically and quickly, as we're seeing with the Baltic Dry, as we're seeing with commodity prices. So the corporations, I believe, Jim, as you, their problem is their top line growth is just not there. Ever mind trying to invest in it, and they have margin issues now that are growing at a phenomenal rate. I believe we could see an earnings recession going forward. The problem, though, that is troubling me the most is last quarter, 90% of all of the profits of the S&P 500 went back into either buybacks or dividends. That is not the capitalist system that's going into growth and investment. That says it may help the earnings per share, but at some point we're not investing enough, though, as you argue, and correctly so, they can't see the growth.
Yeah, and I also think there's another element that goes into financial repression and is enforcing this, and that is poor fiscal policy. I don't care if you want to talk about the Keystone Pipeline. There are so many things that we could be doing right now on infrastructure and repairing that infrastructure, whether it's new energy. I mean, here we have in California, we're not building reservoirs anymore. They're trying to fight these salination plants, and here we are with a drought, Gordon, that is affecting farmers here, homeowners here, and is going to affect the rest of the country because California produces much of the nation's fruit and produce. So we have these poor economic policies that are taking place that I think that are two other features that we're seeing right now, and one is demographics. We have an aging population. That's contributing to it. I think there's a difference in the gulf between boomers and millennials. Millennials are becoming more urban. They're less likely to own a home. They're less likely to, some even own a car. So you have demographics that are feeding into this environment at the present time. And I think eventually, we're going to see a technological revolution take place, which is happening at a rapid pace. So somewhere down the road, with a change in demographics, a change in innovation in technology, I think we'll be on the growth path once again, but it's going to change. It's going to take a change in fiscal policy, kind of what Thatcher and Reagan did in the early part of the 80s, what Cameron is trying to do in England, but what we're not doing here with Obamanomics.
Yeah, our problem is, Jim, is we're trying to steer this ship with one lever, and that is monetary policy. We need fiscal policy, we need public policy, we need strategy. There's so many things that are so blatantly missing because a lot of these issues we're talking about are not cyclical, they're secular, and they're structural.
You know, I was reading a report on by the Social Security Trust Fund, and there's two ways that we could make or fix Social Security. One would be a 1.4% payroll tax. Nobody would really like to see that, with matching contributions by employers. So that's 2.8%. Another one is extending the retirement age, because we do know people are living longer today. So there's things that we can do on entitlements. There's things that we can do in terms of infrastructure spending. There's things that we could do in fiscal policy. I mean, take a look at corporations. We have the highest tax rates, corporate tax rates in the world. So we've got, $2.5 trillion parked overseas. Bring that cash home. Create incentives for corporations to invest, whether it's in infrastructure, modernizing their plants. One of the things that we've seen in this economic recovery is CapEx spending has been anemic. And one reason is, why would I want to bring back money into this country and immediately pay a 35% corporate tax rate? On top of that, any state taxes in the jurisdiction in which I'm domiciled in.
Yeah, you're just not going to do it, and that's a central problem. Also, the growth of small business just isn't there. And matter of fact, I just saw a study by the Gallup group that showed 70,000 net small business losses, that is, have went broke or shut down in the last 6 years. So ever mind maybe 52,000 manufacturing facilities that have left America in the last 15 years. So that's a tremendous headwind to be facing. But in the terms of the small business, they're not seeing the investment growth policies incentives.
No, we've got taxation and regulation, which in my mind are straggling a good segment of the economy. And the thing about financial repression, it works very well with big government and large corporations. And really, as you and I know, the growth engines in this country are those small companies. It's the entrepreneur that starts a company up. And that's where a lot of the job growth is. And these small businesses are being strangled with, I don't care if it's Obamacare, if it's regulations that are coming out. And all of this is basically, hampering business growth and innovation in many of these companies today. And unfortunately, it's the only game in town is monetary policy.
Unless you're a small businessman, you really can't fully appreciate the costs that go in to trying to stay compliant, to try and make sure that you're adhering to all of the laws as they're emerging and policies, especially if you're in the financial sector. It's just incredible. Jim, time goes by so quickly. We're getting up against our hard line. Are there any closing messages you'd like on financial repression or in general you'd like to leave with our listeners?
Yeah, really try to understand it in terms of it. The concept is suppressed interest rates and a steady dose of inflation. And whatever your political beliefs are, investment strategy, you want to use the government's policies and take advantage. So if you know that, for example, money is flowing into the stock market as a result of this liquidity, take advantage of it and use it. The problem is at some point in the future, when everything looks rosy, when it looks like the economy is on track, the stock market is hitting record after record, everybody's exciting, well, that's when you know the end of the game is at hand. But until then, use government policy to take advantage of it, to profit from that wealth, and that really means investing along with companies and being in the market because that's where the growth is. It's not in interest rates that have a negative return and keep you invested below the inflation rate.
Jim, could you tell our listeners how they could follow more of your work, your writings? And I know you just have an outstanding show in the Financial News Hour that some may not be familiar with.
You can find us at financialsense.com. That's Financial Sense. That sense is S-E-N-S-E, like common sense. Financialsense.com. We've got a lot of articles, and we have shows from interviews to the weekend show to retirement planning, 6 out of 7 days a week.
Must cite for any of our listeners to visit, and once you're there, you will go back. Jim, it's been a pleasure. Absolutely enjoyed our conversation. Sorry it had to be short, but a lot of our listeners listen to this on podcasts and as they commute or as they're jogging. So thank you for your time, and we'll have to have you back again.
Thank you for inviting me. All the best.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.